Right, this is Dr. Seitz again, and I'm going to complete the problem that we were just working on here with the crystal apples. We're going to do the LIFO method. So I talked a little bit about the LIFO method in the last video. I did all the FIFO in the last video. So again, here are our available for sale. This is what's total available for sale for the year period. I'm always going to try and break up that total available for sale. That would be broken up between the income statement by cost of goods sold and the balance sheet as ending inventory. I will always have 160 items in this particular problem. No matter which cost flow method I use, I will have 160 items costed on the balance sheet. So this is 160 units on the balance sheet, and then I will cost the amount that I sold, which is 2,040. And so those two items are 2,200, which is the available for sale. So that is the purpose of this cost flow assumption. If you are a company, you will pick one method and go with it. You cannot flip back and forth. If you switch, you have to put a note in the financial statements as to why you're switching back and forth or from one method to the other. All right, so again, like I talked about before, I know that I sold 2,040. My job is to put a total cost on those units, okay? I'm going to take this 48,400, the total cost of units, and I'm going to determine how much of that is going to be in cost of goods sold, and then how much of that will be in the ending inventory. So if I start in last in, first out, I'm going to start here with the second purchase. Last time I started at the beginning purchase, but that would be first in, first out. This is last in, first out. So I'm going to start with the items that came in last. So that's 1,200 units. The cost per unit is $24 per unit. So the total cost for those is $28,800. All right, I need to get to 2,040. So I'm at 1,200. I'm not quite there yet. So I'm going to go to the next layer, the first purchase, the next layer. And out of that 800, I'm going to take the full 800 because that's going to get me to 2,000. Those cost me $20 a piece. So there's $16,000 worth of inventory. So I'm at 2,000 units. But out of this beginning balance amount of those 200, I only need 40 of those units to get me to that amount. So those 40 units, those were $18 a unit. And so 40 times 18 is 720. That total amount is 45,520. Okay, 45,520. And so that means then out of the total amount for ending inventory, the cost available for sale, 48,400, which is what I'm alluding to right here, 48,400, less the cost of goods sold of 45,520. That means my ending inventory, which is what I have calculated down here, should be 2,880. So remember, what's available less your cost of goods sold, which is what we calculated right here, equals your ending inventory, which is right here. Okay, so you can do this in dollars or units. Works out in dollars or units. Okay, so remember me saying in the last video that really with the horizontal balance sheet, income statement, and statement of cash flows, really the only thing that changes is how I cost for the items in 2B. That was the only one that would be different. So instead of having a decrease of 44,560 as the cost of goods sold expense, we now have a cost of goods sold expense of 45,520. So everything else would remain the same except for that cost of goods sold, which, as you'll see in the next step here, that affects your income statement, it affects your balance sheet, doesn't affect the cash flow statement because it's not an actual cash expense right then and there. It's only a cash expense when you pay down the ending or you pay down your accounts payable. But as you can see with the last in, first out LIFO method, what we just did, it has a higher expense. With a higher expense means a lower net income. Now this might be okay. If you're trying to decrease your tax bill, this might be okay. Because remember, you take the tax percentage times your income, and that will help you determine what your income tax would be. So if you have an increase in expense, which decreases your net income, if your goal is to decrease your tax bill, which would help with your cash flow, you would have to pay less cash today out for taxes, then you might want to use the last in, first out method. If you're trying to increase your net income, then you're going to want to choose something that is less, which is the FIFO method. Now, the reason why the last in, first out method has this effect on the income statement is because look what's happening to these prices. This is a period of inflation. So at the beginning balance, they were only worth $18, then 20, then 24. So we have a period of inflation here. If this was a period of deflation, then what I just showed you right here would actually be opposite. If this was a period of deflation, you would actually see a decrease in the LIFO method would actually be a lower amount. So pay attention to that. All right, the final method that we have here is the weighted average method. So I'm going to have the exact same chart that we had done before. And so we are going to calculate a weighted average method. We have a total cost here of 48. I'm going to highlight this. The total available for sale is 48,400. So 48,400 divided by the number of units, 2,200 units. That means that we have a weighted average price of $22 per unit, okay? Well, if I sold, which is right here, $22, if I sold 2,040 and then I use this cost per unit, I can quickly calculate 44,880. Okay, that can be a cost of goods sold. So that would be the cost of goods sold amount. It's quite simple to do it that way. If you do that, that means that it would leave you with an ending inventory of 3520. So remember, available for sale less cost of goods sold equals ending inventory. So 48,400 less cost of goods sold of 44,880. That would leave your ending inventory of 3520, which is what we have right here. Okay, and same discussion as before. This amount that would affect 2B and your retained earnings right here and your income statement right here. Your ending inventory. So it appears here that you can just add the LIFO, FIFO together and divide them by 2 and get a good average for the weighted average. That's not necessarily how it works in real life. You can see that we're stepping up by $2 here and by $4 here. And so, it might not be that perfectly stair-step pricing whenever you go to do the calculation. So that's why it looks like the weighted average could possibly be an average of LIFO and FIFO, but that's not always the case. So please do not, please refrain from just adding those two together and then dividing by 2. That doesn't work out every time. Okay, and then finally, the last step of this is to see how this would affect the financial statements. So remember, if you were a company, you would pick one method and go with it. But we are doing this because I want to show you what the effect on the financial statements is based on just your assumption method. Remember, this does not have to follow your flow of goods. And so we use cost flow assumption methods to help us calculate these numbers, because specific identification, which is another method, you need to make sure that you are aware of that method in your textbook, is not really convenient, especially if you are in a business where you're basically running manufacturing items. All right, so sales for the all three methods. Oh, I don't want to use red. Sales for all three methods. This was the number of crystal apples that we sold times the selling price, or 81,600. 81,600. 81,000. That doesn't change. 81,600 doesn't change. So you remember it was right here in 2A. 81,600. That was the number of crystal apples sold times the sales price, which I believe was $40 an apple, I believe. Okay. Now here's the big deal. This is where the cost of goods sold changes. This is where our income statement will change. So we calculated 44,560 for FIFO. We calculated 45,520 for LIFO. and we calculated 44,880 for weighted average. That's what's going to change the whole direction of this financial statement. Notice our gross margin will be different now because of it. And even though our operating expenses don't change, you can see here they're 26,000. Our net income will change, which is how our tax bill would be different based on the cost of goods sold calculation. So notice in a period of rising prices, in a period of inflation, FIFO would give you the highest net income. So if that's your goal, then FIFO would probably be the best bet for you. If you're looking to decrease your income tax bill, then one of these two methods, especially the LIFO method, in a period of rising prices, a period of inflation, we saw the price of our purchases increase over time. LIFO would give you that particular benefit. But here's the thing, international accounting standards do not allow LIFO, and so you'll see a lot of companies actually moving away from LIFO. The reason why is because of this particular instance right here, last in, first out, it doesn't really mimic the flow of goods for most companies, and so they don't think that it's representative and matching of the accounting process. All right, so if you're looking at the balance sheet, you would see that cash, no matter what, cash didn't change, 12,800, no matter which method we would have chosen, 12,800. Here's what would have changed though, ending inventory. So ending inventory would look different based on which method you would choose. So under FIFO, it was 3840, and I'm pulling this all from the chart that we did in prior screens, 2880 and 3520. So notice our total assets would be different too because of the inventory difference. What doesn't change? Common stock doesn't change. All this was given in the problem. Retained earnings, though, would change, and that's because retained earning changes because cost of goods sold is different, and then it's expense, and all expenses affect retained earnings. They decrease retained earnings. So depending on the amount of the expense, that would affect the amount of retained earnings. So that's something to consider. All right, so let's look at cash inflow from customers. This is the sales of the crystal apples. That did not change no matter which method. Okay, cash outflow for inventory, what I actually paid for that in cash, that didn't change if you remember. Okay. Cash outflow for operating expenses, none of that changed. Doesn't matter which method you use. 26,000. Okay. Net cash inflow from operating activities, that's still 10,800 no matter which method you choose. 10,800. Okay. Cash flow from investing and financing, we didn't have any of those. Kept it real simple for us this time. Net increase in cash, 10,800. 10,800. 10,800. And then we had a beginning cash balance of 2,000. So in this particular example, this did not affect the cash flow statement. If we would have had income tax payments, that would affect the cash flow statement. But and remember, income taxes were affected by this cost of goods sold up here. So that could have been where we would see a difference on the cash flow statement as well. All right, let me know if you have any questions. Good luck, and don't feel like you can't reach out to me. I want to make sure that you feel like you have the ability to ask me questions. We can either use this particular software and we can go through problems, or if you want to come meet in my office, that's fine.